Recently, it's become more and more apparent that things like the national debt are extremely important after we breached the $33.7 trillion level recently. It's also become more and more apparent that the interest costs on that debt are also becoming more and more of an issue, with interest costs surging 87% since last year. It's also clear this is feeding into a growing budget deficit, seemingly spiraling out of control. It's also becoming more widely known that the money leaving the reverse repo facility at the Fed is funding a lot of this right now, with analysts now saying that the Federal Reserve should stop quantitative tightening before this repo facility is drained. But all of that hinges on the one event that takes us from the current phase to the next phase. We have to discuss how this transition happens. And in this video, we are going to discuss exactly that. What happens when a Treasury auction fails? First up, what is a Treasury auction and how does it work? Well, as you might guess from the word auction, it operates very similar to any other auction, similar to if you were to be selling something through an auction on eBay. You have something to sell, you want to get a specific number of dollars for it, and anybody else out there who wants to bid on it, to buy it, can do so. You may walk away with more or with less money than you originally asked for. When the US government wants to borrow debt, they have a Treasury auction, and it operates very similarly to this. The first step is that they come out and they say, hey, we're gonna be borrowing this much amount of money, and we're gonna be paying this much as an interest rate on that debt. Now, this is a process that takes place all the time, multiple times a week. The US Treasury is constantly borrowing through Treasury auctions. Now, it's important to note here that the US Department of the Treasury is often referred to as the Treasury. And bonds that the government borrows, those are often referred to as treasuries. The US Department of the Treasury is the entity that issues the debt, that takes care of the finances for the government. When they borrow money, they do so through the creation of a bond that we refer to as treasuries because they're called treasury bonds. So when the Treasury sells treasuries, that's the same thing as saying the United States government just borrowed a bunch of money. Clear as mud? All right, let's move on. So the Treasury says we're gonna hold an auction where we're gonna sell some treasuries. We're gonna borrow some money from you. We've got two groups of people that are gonna line up as buyers of that debt, which is the same thing as saying they're going to lend money to the government. The first group is the group of people that places non-competitive bids. We're going to call these individuals because that's the only thing individuals can do. Essentially, if the government says we're going to borrow at 5% and you want to participate in that, you can't say, well, I'd like to lend to you, but only if I can lend at 6%. No, individuals are locked into non-competitive bids, meaning you can only lend at the rate that the government is offering. The second group of lenders is going to be able to place competitive bids, which just means that they can say a certain price, saying, hey, we will lend to you, but only if we could do it at, let's say, 5.05%. These are going to be institutions only, although institutions can, if they want, place non-competitive bids. But we'll just say for clarification, for ease of this example, we've got individuals and institutions, small money and big money. So the government says we want to borrow $1 billion at 5%. You have the first group of individual small money. They get in line and they say, okay, we'll lend you all of this money that we want to lend you at your stated request of 5%. And let's say that makes up half of what the government needs to borrow that day. So we've got $500 million over here that goes to be lent to the US government to purchase those bonds at the 5%, which is what the government is offering. But the institutions over here that are trying to get a little bit more, maybe they're offering at 5.01% or 5.02%. And maybe if they can get up to 5.03%, there's a lot more than $500 million left in this pool to be lent to the US government. Maybe there's another billion sitting over here. That means altogether the lenders right now, in our example, we've got $1.5 billion that is willing to be lent to the US government today. The government's only trying to borrow $1 billion. Well, obviously it's going to operate in its own best interest, which means it's going to soak up all of the $500 million from the group that is going to pay the rate that the government wants to pay, the 5%. But once it borrows all that $500 million, it still needs another $500 million to meet the rest of its $1 billion that it's trying to borrow. So now it's going to go to the second group that's trying to get a little bit more. Of the rest of that $500 million that is trying to get a higher rate, let's say there's 250 million of it that's saying I want 5.01%, another 250 million that's saying I want 5.02%, and the rest of that $1 billion is asking for much, much more. Well, the government only needs $500 million more, so it's going to go to that first group of 250 million and that second group of 250 million, which ends at 5.02%. Well, at this point, if you're thinking, well, that's not fair because only institutions can ask for a higher rate, don't worry, everybody gets the high yield, which means if that last rate that the government has to pay to fill up the rest of the debt it's trying to borrow is 5.02%, well, everybody then gets 5.02%, which means that for the government to borrow $1 billion on that day, they had to pay 0.02% more than what they originally planned. 0.02% is equal to 2 basis points or 2 bips. And remember those definitions for later. So in theory, that is how an auction works. The government says we want to borrow this much, everybody gets in line and they borrow from the bottom up, and whatever the top rate is they have to pay, they pay to everybody for that auction. So now that we know how it works, what exactly is normal? How does this usually work out in practice? Well, 2 conditions are considered normal. Number 1, there is plenty more money willing to be lent than the government is trying to borrow. Simply put, there are more dollars available to be lent than there are dollars the government's trying to borrow. The difference between the number of dollars there are that the government could borrow and the number of dollars they're actually trying to borrow on that day is called the bid to cover ratio. And usually that number is well above 2, which means if they were trying to borrow $1 billion, then there'd be $2, maybe even $3 billion available for them to borrow from. The second condition that is considered normal is that the high yield, or the rate that the government ends up actually paying, is pretty close to what they started off with. So if they say, hey, we're going to auction off $1 billion worth of debt at 5%, then maybe they end up paying 5.01% or 5.02%. So the normal conditions for the Treasury market is that the Treasury gets to borrow from a pool that is much larger than what they're trying to borrow, and they usually get to pay very close to what they want to pay. But in early November 2023, something not normal happened in the Treasury market. This chart from Zero Hedge is showing a graphical representation of something called the tail. The tail is simply visualizing what the difference is between what the government wanted to borrow their debt at and what they ended up having to pay. In our example, they wanted to borrow at 5% and they ended up paying 5.02%. That was a difference of 2 basis points, 2 bips. You can see normally the difference does not dip below 1 basis point, but every once in a while it dips below 2 basis points. But in November, the tail exceeded 5 basis points, which meant the US government had to pay 5.3 bips more than what they originally wanted to pay. You can see this data going back to 2016. That is a record. So the question is, why did they end up having to pay so much more than they originally wanted? Well, the answer is there were a lot fewer dollars available for them to borrow from than normal. As James Lavish pointed out on Twitter recently, this left dealers saddled with almost a quarter of the entire issue, while the recent average was 12.7%. Remember the bid to cover ratio we talked about earlier? That's the difference between how many dollars there are available for the government to borrow from versus how many dollars they actually want to borrow. Well, that ratio was at 2.236, and that's the lowest since December of 2021. By the way, James Lavish on Twitter wrote a fantastic thread diving into the details and the terminology much deeper than what we are covering today. I will link that thread below. I highly recommend checking it out if you're interested in going into the details more. So in summary, in early November, the US Treasury tried to borrow a bunch of money. Not only were there less dollars available for them to borrow from than there normally are, that also meant that they were left paying a much higher rate than they normally have to pay relative to what they originally asked for. That leaves everybody asking the question right now, is this something that is just an anomaly? Are we to see more of this, or is something more severe coming down the pipeline soon? Well, here's what we can expect for the time being. Number 1, Anytime the government tries to borrow at the long end of the curve, this means 30-year treasuries, 20-year treasuries, or 10-year treasuries. Those auctions will probably fare pretty similarly. A low bid to cover ratio and a long tail, meaning the government will have to pay more than they originally wanted to. This is because liquidity is drying up, inflation is sticking around, and more investors are looking at US debt as less appealing, with bonds even from emerging markets now exceeding the yield that treasuries pay. Because of this, the US Treasury will probably lean on borrowing at the very short end of the curve even more and more. This means they're going to be borrowing debt that matures in 2 years, 1 year, 6 months, or even less. This is because when they borrow at the short end of the curve, it pulls cash out of the reverse repo facility, which currently has just over $1 trillion left in it. So as of right now, the US government can borrow roughly $1 trillion more at the short end of the curve, and they don't have to worry about it pushing yields much higher. This is because the money inside this reverse repo facility is currently getting paid 5.3%. So anytime the government borrows at the short end of the curve around 5.5%, that's better than what that money is getting in the reverse repo facility, and so it pulls money out of there as that cash seeks the higher yield. It's important to note that this doesn't happen for long-term debt, because any of those dollars in the reverse repo facility are there for liquidity needs. That is short-term cash. So none of that money can be or wants to be locked up in long-term debt. If we plot the rate of decline of the reverse repo facility from May until November, then it would be reasonable to expect that the reverse repo facility will be completely drained by March or maybe April of 2024. If the rate at which the facility has been declining since October until November continues, then this facility could actually be drained earlier by as early as January. And once this facility hits zero, that's when hits the fan. So now let's go through the process of what it looks like when an auction fails and what will happen immediately after. Number one, the Treasury tries to borrow a specific number of dollars. They fill from the bottom up, starting with the non-competitive bids from like individuals, and that's not enough. So they go over to everybody else who's offering competitive bids, trying to get a higher rate. And even once they burn through all those dollars, there's no more dollars left. Now, in order for just that part to take place, that also means that that last dollar that they're borrowing is probably going to be way more than 5 bips above their current rate. So instead of trying to borrow at 5% and paying 5.05%, they may try and borrow at 5% and end up paying something like 6%. Now, 1% might not sound like a big deal to you, but in the bond world, that is considered catastrophic. Now, if that wasn't bad enough, the reality is, at that point, they still would not have borrowed all the money they needed to borrow. It'd be like them trying to borrow $1 billion, yet only $900 million comes out of the woodworks. Not only is it less than they need, but they also have to pay way more on everything. Remember, they backfill that rate. If that last dollar they borrow at 6%, everybody gets 6%. This would be a failed auction where somebody could have come in and offered to lend the US government money at 7% or even 8%, and they would have gotten it. But despite there being no theoretical limit to the rate that you could lend to the government at, the rate at which they would borrow at, there's not enough dollars to lend. At this point, number one, there would probably be an immediate, swift sell-off of US treasuries. This would be a massive disruption in what is supposed to be the most liquid and safest financial asset in the world. In one moment, it would be proven that that is false. Now, they would not be just out of money at that point, and a failed auction also doesn't mean that the government defaults on its debt, because the government has this little account called the Treasury General Account, which currently has about $772 billion in it. So if they need to borrow $1 billion but can only borrow $500 million, the rest of it would be made up by just spending it from their checking account, the Treasury General Account. But it would signal a massive emergency. And at this point, the only way out will be the Federal Reserve. One option that the Federal Reserve has at this point is to restart quantitative easing. Quantitative easing is when the Federal Reserve buys assets just like treasuries, which grows its balance sheet. They buy these by digitally printing money. That new cash ends up in the hands of the US government, just like it happens anytime even a regular bank purchases a US Treasury, lends that money to the US government. But restarting quantitative easing and growing its balance sheet yet again still may not be enough. There are historical examples of when a central bank decides to do something similar to quantitative easing, it actually incentivizes the rest of the bondholders to sell. Because if I know my thing is only worth this price, but there's a central bank printing money to buy it at this price, well, I'm going to sell to them at that price because I'm getting more for it than what it's actually worth. A great example of this is the Mississippi bubble when John Law took over the central bank in France about 300 years ago. Great story. I highly recommend reading up on it. But if the Federal Reserve starts up quantitative easing again just by buying some treasuries, it still may not be enough to counteract the selling forces and the lack of liquidity in the system. At that point, they may need to engage in the Japan playbook and start up yield curve control. Now, quantitative easing and yield curve control are qualitatively two different things. QE is saying I'm going to buy a certain number of assets every month. Yield curve control is saying I'm going to buy as many of them as needed to maintain a specific price. A good example is if Apple wanted to artificially boost the price of used iPhones, they could say, hey, we're going to buy 1,000 used iPhones from eBay every single month. That would boost the prices of used iPhones a little bit. But if they wanted to nail the price and say, no, every used iPhone is going to be $1,000, then they would have to buy an unlimited number of iPhones from eBay until the price reached $1,000. They would also have to sell an unlimited number of iPhones, used iPhones on eBay, if the price exceeded $1,000 to maintain a peg. And that second category is yield curve control. It's buying and selling as many treasuries as needed to maintain a specific interest rate. Now, restarting QE, or even going so far as yield curve control, both have two issues with them. The first one is legality. Contrary to the incorrect theory, modern monetary theory, the Federal Reserve and the federal government are not the same entity. And the Federal Reserve has had to jump through hoops in interpreting the law in order to engage in QE in the past. Recently, Jerome Powell has been extremely clear that he does not want to help the federal government out of the fiscal hole they've dug for themselves, saying under no circumstance would the Federal Reserve step in to help refinance the government's debt. He's even gone so far as recently to be critical of the US government and their out of control spending. The fact is that quantitative easing is not explicitly allowed for the Federal Reserve to engage in. If a US Treasury auction were to fail, that may be enough disruption in markets for them to justify breaking the law again and restarting QE, but it may not be because of the second reason. And this second issue with the Fed restarting QE or going so far as yield curve control is the inflation issue. Even if you look at the official rate of inflation, it has been moving higher and higher recently. And if you take a look at the month-over-month numbers instead of just the year-over-year numbers, we can see that every single month it's been creeping higher and higher. And that's if you just use the official numbers. The Federal Reserve has two mandates given to it by Congress that legally its only two jobs are to maintain stable prices and maintain maximum employment. They understand, because they've engaged in this activity in the past for the express purpose of manipulating prices, that quantitative easing has upward pressure on prices. And the rate of inflation has not come down to anything remotely stable, even by their wrong definitions. And so if the Federal Reserve restarts QE in order to flip over and help the government, they restart inflation again. And it hasn't even stopped yet, which puts them in a bind because legally they're not able to take an action that would conflict with their legal purpose given to them by Congress. And this is why it is my opinion that there may be a very short-term battle between the Federal Reserve and the US Treasury in which Congress would ultimately win, because the Federal Reserve exists at the sole discretion of Congress and it does what Congress tells it has to do. And if the Federal Reserve is no longer serving Congress or what it wants the Fed to do now, they will simply rewrite the Federal Reserve Act. They've done it before and they can do it again. And at that point, things flip. No more deflationary pressures, no more Fed tightening. The Federal Reserve will exist only to fund the United States government. And unless we get some people in charge who have courage, morals, and competence, the scenario that I've described is simply a matter of when. It's not even a question of if. And finally, if you are not a member of Heresy Financial University yet, you are missing out because number one, you get unlimited access to thousands of dollars worth of training material that will teach you how to make tens or even hundreds of thousands of dollars more than you are. You get access to members only live streams where we do Q&A sessions to talk about the markets, investing, economics, trading, and much more. And one of my recent new members just left a review about an options trade because one of the courses teaches you advanced options trading strategies like hedging techniques and asymmetric trades with very small downside risk and very large asymmetric upside returns. And he said a trade that he did recently went the wrong way, so he sold and bought back and he lost about $50 on the trade. But his trade was a spread, which is one of the strategies that I teach. And he said, had I only bought the put, which is what he would have done prior, he would have lost between $480 and $680, which means that that one new tool that he learned alone paid for half of a year's subscription, which is currently $99 a month. I'm constantly adding new training to the library to help make you more and more and more money. And because of that, I'm raising the price next year. If you join next year or later, the price will be much more, but if you join now, your price is locked in forever, $99 a month. So stop missing out on making more and losing less. Sign up today, link is in the description below. As always, thanks so much for watching. Have a great day.